This is strategic hedging with options and futures, optimizing the put debit spread for your hedging needs. This video is for educational purposes only and not investment advice. Put debit spreads are commonly used to hedge downside risk because they reduce upfront cost relative to long puts, limit vega exposure, and provide defined risk. In practice, many traders are disappointed by their performance. The problem is not the structure, it's misunderstanding how put debit spreads behave before expiration. So a quick review, a put debit spread is a bearish debit-based option strategy. You buy one put at a higher strike and sell one put option at a lower strike. Both options have the same expiration date, and the result is a net debit. That's your maximum potential loss. This structure reduces theta and vega exposure relative to long puts, and it's important to understand here that you are trading convexity for cost control. Okay, so I want to move into the option strat software here and build out a put debit spread for analysis. I have SPY populated in the trade tab here, and we're looking at the March 20th, 2026 options expiration cycle, and these options expire in 88 days. First, let's take a look at where SPY is trading. We can see here that SPY is trading just over $680 per share. So let's begin by selecting our long put. For the purposes of this example, let's assume that I want to purchase a put option at the 640 strike price. So I'm going to buy the 640 strike put option, and we're going to increase the range here. And first, let's just take a look at the characteristics of a long put. We know that a long put has positive convexity because it has positive gamma, and that's demonstrated here by this nice curvature of the T+0 line, meaning as price begins to move in the direction of your long put, the put becomes increasingly profitable. So the line is convex, it's not linear, which means you become increasingly profitable as price moves in your direction. There's a trade-off to that. This position has negative theta and positive vega. So this means that time is not kind to this position. If you don't get the downward price action in a timely manner, this position is going to decay. And we can see what happens to this T+0 line as we move the slider, the time slider, to the right. We can see that that T+0 line falls, making it more difficult for this position to make money. Okay, now we know that this has positive vega, meaning that an increase in implied volatility will be helpful for the position. However, if implied volatility goes down after you purchase this put, that's going to hurt the position. So let's reduce volatility, and we can see that that T+0 line goes down here, making it, once again, more difficult for this position to make money. So what do traders do to minimize the effects of negative theta and positive vega, as well as decrease the cost of the overall trade? Well, they go out and they sell a put option against the long put option here. So for the purposes of this example, let's assume we're going to sell the 620 strike put against that. Okay, so when we do that, we can see here that theta improves dramatically. It's still negative theta, but it's much improved, and same with vega. Vega dropped tremendously, making this position a little bit more resilient to the passage of time and changes in implied volatility. So now let's go ahead and move the slider to the right and just watch that T+0 line. And we can see here that the position does sag a little bit as time moves on. But the effects of time are much less dramatic compared to a long put. And now let's change implied volatility and look at that T+0 line. Increase in implied volatility actually flattens, and we'll get into that in a second. But if we reduce implied volatility, it's not that that T plus 0 line doesn't sag a little bit, but the effects of reduced implied volatility are much less compared to the long put. So that's the key takeaway here. Now let's touch on the concept of negative expectancy for those who may not be familiar. Negative expectancy means that on average, a strategy is mathematically designed to lose money the more you trade it, regardless of streaks or your feel. Put debit spreads generally have negative expectancy as standalone trades. Their purpose is risk transfer, not consistent profit generation. And as a result of negative expectancy, cost minimization and adjustment optionality are essential design criteria when looking at put debit spreads for hedging. So this naturally leads us into a discussion about put debit spread design optimization. So the design of a put debit spread should always flow from its initial purpose. And this is because optimal structure for, say, a static hedge is fundamentally different from one built for ongoing adjustment and monetization. This is important because a spread designed to be held to expiration may look materially different from one designed to be actively managed. So for example, if the goal is time-specific risk control, simplicity and certainty may be prioritized over flexibility. And this may come into play for people who are trying to hedge for sequence of return risk. Say you're in early retirement and you have some ETFs that you would like to hedge because you know you need to draw income from those positions. You're at heightened risk for sequence of return risk in early retirement. And therefore, you may set up hedges that are simply a set and forget. You hope you don't need them, but if you do, you know exactly what you're going to get from that hedge. And as a result, you're going to hold that until expiration. Conversely, if the goal is dynamic portfolio management, say, for example, the goal of the hedge is to have something to monetize in order to purchase assets if we get a market sell-off, then you're going to want to design that hedge differently. Spread width, liquidity, and expirations that preserve optionality become far more important to you. Okay, now let's talk about spread width as it relates to put debit spread design optimization. Spread width is a critical design variable, particularly because put debit spreads are rarely held to expiration when used for dynamic portfolio management. And that's because of that negative expectancy. When you put on a put debit spread and that spread becomes profitable, rarely do you want to just sit on that and not actively manage those profits. You want to be actively harvesting gains from those positions. And as a result, you need to have spread width working in your favor. Narrow put debit spreads tend to offer limited payoff potential and are difficult to manage dynamically. So with narrow put debit spreads, you're often faced with a binary choice of, do I close the position or do I keep the position open? Unless you're holding several contracts, you can take partial profits, but that's pretty much all you're looking at in terms of management potential. Wider put debit spreads are generally preferred for dynamic portfolio management purposes due to their increased price sensitivity, and they have much more optionality for trade management. Okay, I want to move into the thinkorswim trading platform here to demonstrate what we just discussed. I have SPY populated in the charts tab here, and we actually recently experienced some market weakness in mid-November. We can see here that on November 12th, SPY was trading near its all-time highs and experienced several days of market weakness. And we are going to take a look here at how some put debit spreads would have performed had we put those on right before this market weakness. So let's head over to the Analyze section of the software. I have SPY populated in the Charts tab, and we're looking at the thinkBack section in that Charts tab here, and I have November 12th, 2025 populated. And that was just before the market started to sell off. So let's assume that we entered into some put debit spreads on January 16th of 2026. So these options would have expired in 65 days. And we can see here, let me scroll down. We can see here that SPY was trading at $683 per share, roughly. And for the purposes of this example, let's assume that we wanted to purchase a long put somewhere near a 30 delta. So let's go ahead and purchase the 660 strike put option. And for the first example, let's say that we wanted to purchase a 10-point wide put debit spread. So I'm going to go ahead and sell the 650 strike put option against that. And let's see what this spread would look like on November 20th, which was kind of the bottom there of that recent bout of weakness that we saw. And we can see here that in order to enter into this 10-point wide put debit spread, we would have paid a debit of $1, roughly 78 or 79 cents. And on November 20th, after we got that down price move, the spread would be profitable by $133. Now, how does that relate to the potential payout of that spread? So we know it's a 10-point wide spread, and we know that we paid $1.79 for that. So the max profit on this spread would be $8.21 or $821. And the spread is profitable by $133. So nowhere near its max profit, but profitable nonetheless. So let's go ahead and fast forward to November 20th here to see what this spread would actually look like in the options chain. So we're going to scroll down here and we can see that that 660 strike put option is now just out of the money. And of course, here's the 650 strike put option. And if I wanted to keep the position open, but somehow harvest some profits from this, there really isn't much I can do here. I could sell the 660 strike put option and buy the 655 strike put option, and that would give me a credit of $1.64, but that would leave me with a 5-point wide put debit spread, and really that isn't going to do a whole lot. So basically, what I'm looking at here is a decision. Do I hold the put debit spread and hope that the market continues to sell off and move downward so I can harvest more profits from this put debit spread? Or do I simply lock in profits at $133? So really it just becomes a binary choice. What do I do here? All right, let's look at a different alternative. So let's go to November 12th here. We're gonna reset this. And this time, we're going to select the same long put option, just for the purposes of comparison here. So we're going to purchase the 660 strike put option. And let's say I want this spread to be at least 50 points wide. So I'm going to go down to the 610 strike here. And this time I'm going to sell the 610 strike put option against the 660. So now this put debit spread is 50 points wide. The trade-off for that is, of course, it's more expensive. We need to pay $5.85 for this put debit spread, but let's calculate what the max profit is going to be. So it's 50 points wide. We're paying $5.85 for it. So the max profit on this is $44.15 or $4,415. So yes, you're paying more, but your potential max profit increases. Now, we know that we don't generally hold these to expiration when these are used in dynamic portfolio management. So let's fast forward and see what would happen on November 20th for comparison's sake. And we can see here that it's not too surprising. This spread is showing a bigger profit than the previous one. We paid more for it. It's a wider spread, so you would expect to see a bigger profit. But let's take a look here at what we can do with that profitable position. So if I scroll down, from the previous example, we know that that 660 strike put option is now just out of the money. And what are our options here? Well, we could monetize the position and take the $465 and do what we want with it. The other alternative is we can roll the 660 strike put option down. So we would still maintain a put debit spread, but we would be harvesting those gains. So let's take a look at what we could get out of that. So let's sell the 660 strike put option. And let's say we really wanted to narrow that spread. We're long the 610. What if we were satisfied with maintaining a 10-point wide put debit spread here? So let's go ahead and just buy the 620. So we sold the 660. We sold out of that. And we bought the 620. That adjustment would bring in a net credit of $9.20. So in order to open the position, we paid $5.85, and this would bring in $9.20. So if we take $9.20 minus what we paid to open the position, we're looking at a net credit on the trade of $3.35 or $335. And we get to keep the 10-point wide put debit spread. So if the market were to continue down, that put debit spread in theory would continue to make money. So when you have a wider put debit spread, yes, you pay more for that. But when you do get price action that benefits that hedge position, when you have a wider spread, you have more flexibility on how you want to manage that so that you're not just sitting there with a binary choice. Do I buy or sell? There's different management options that you have when the spread is wider. Okay, so let's move forward with this discussion based on design optimization as it relates to strike selection and expiration choices. Because put debit spreads are typically managed before expiration, the primary focus should be on how the position behaves in real time and not by maximizing theoretical payoff at expiration. So a lot of times we'll get kind of hung up at looking at these profit and loss diagrams, and it's easy to lose sight of the fact that what we really need to be paying attention to is the T+0 line. So as a result of this, strike selection and expiration choices should be driven by how they influence the T+0 risk profile, not necessarily the profit and loss diagram at expiration. Okay, let's move into the thinkorswim trading platform here and just demonstrate what I just discussed. I have SPY populated in the trade tab. And for the purposes of this demonstration, I'm going to open up the February 20th, 2026 options expiration cycle. Those options expire in 60 days. And I want to begin by entering into a 10-point wide put debit spread with the long put at around a 30 delta. So there's the 30 delta. And here is the long put selection. The 665 strike price is what we'd be buying. And we want that to be a 10-point wide put debit spread. So let's go ahead and sell the 655 strike there. And we can get that trade accomplished for roughly $1.64. Prices are bouncing around a little bit, but that's generally where we're trading right now. Okay, so I want to move into the option strat software where I have this exact same trade populated in the charts tab here. We're long the 665 strike put and short the 655 strike put in the February 20th, 2026 options expiration cycle for a debit of $165. And we can see here that the max profit is roughly $834. And we know that we aren't so concerned about that because the odds of holding this thing until expiration are very small. What we're more concerned about is this T+0 line and how this matches up with our portfolio hedging needs right now. So we are in a 10-point wide put debit spread, and based on the previous discussion, we know that we can optimize these spreads for optionality if we can get them wide. So the wider we can get, the more optionality we have for adjustments. So let's just take a look at what would happen. How would this spread perform based on the T plus 0 line if we went ahead and widened this structure while staying within our $165 budget? Well, we can widen the structure while staying within this budget by moving the strikes further away from the money. So let's go ahead and just play around here. I'm going to move the 665 strike put. I'm just going to arbitrarily pick the 640 strike here. No magic. I'm just playing around. Let's slide the short put and see how wide we can make this spread while still staying within that $665 budget. And it looks like I can create a 25-point wide put debit spread for roughly $170. So pretty close to $165. The trade-off here is that the long put is quite a bit further away from the money at the 640 strike. But let's see what that does to the T plus 0 line. So it's kind of nice about this software here is this white line actually shows you the value of the spread, the T plus 0 line, based on the spread that we just looked at, the 10-point wide put debit spread that was closer to the money. And we can compare that white line to this solid green line, which is the current spread. So let's assume that SPY trades down to $640 per share. We can see here that this 640, 615 put debit spread actually outperforms the 10-point wide put debit spread that was closer to the money. Okay, the value of that spread is going to be $500 and roughly $40, and these are just estimates. But the theoretical value of that spread is going to be a little bit higher than that tighter put debit spread that's closer to the money. And what you want to do is take a look at that value and ask yourself, does that meet your needs? Does that meet your hedging needs? Now, usually a downward price move comes with an increase in implied volatility. So let's increase implied volatility and see what that does to the performance of both spreads. So as I move the slider, I want you to keep an eye on that solid green line as well as the white line. And we can see here that an increase in implied volatility generally brings the T plus 0 line down. It hurts the effectiveness of the spread. So if we're assuming that SPY is trading down to 640, say, the performance of that further out of the money wider put debit spread is actually higher relative to the tighter put debit spread that is closer to the money. So you may look at this and you may say, okay, wow, no brainer. Let's go ahead and enter into this 640, 615 strike put debit spread, right? Because it outperforms the tighter, closer to the money one. The trade-off here is going to be time. So you're further away from strike, and we know that options that are further away from the money decay faster than options that are closer to the money. And that's just basic decay curve dynamics. So let's just quantify that. So let's take a look here and move this slider over. Again, paying attention to the white line relative to the green line, because we're comparing the two trades. And at any given time in the trade, you can take a look at how this would perform and match it up with what your portfolio needs will be. So I just want to provide you with a framework of how to play with these trades and analyze strikes to optimize your specific needs. Okay? Okay, so now let's shift the discussion to optimizing this for expiration cycles. We all are going to have different needs with regard to expiration cycles. If you're a short-term trader, you may have short-term needs. If you're a long-term trader, your needs aren't going to be short-term in nature. We're all different. So I want to provide a framework for you to begin to analyze hedging so that you can apply it for your specific situation. So we're currently looking at the 640, 615 strike put debit spread in the February 20th, 2026 options expiration cycle. And we can see that this trade has 60 days remaining in the trade. That's what we just went through. Let's go ahead and move the expiration cycle out to June 18th of 2026. That's 6 months in duration. We can see here that going further out in time increases the cost of the spread, which isn't a surprise. The cost would be $371, which would bring the max profit down to roughly $2,129. But again, we're more concerned with this T plus 0 line. And we're more concerned with how this spread reacts to the passage of time, as well as changes in implied volatility. So because we're going further out in duration, time, especially early in the trade, is going to be less detrimental relative to the February 20th, 2026 options expiration cycle. And you can compare that with this white line here. That's what that represents. Same with changes in implied volatility. If we increase implied volatility, this spread, because it is further out in time, isn't going to perform as sensitively as well as the shorter duration. And that's because we know that these put debit spreads widen when they're in the money, the closer they get to expiration. Okay, so this is a framework for you from which to build your hedges so that they're appropriate and optimized for your specific situation. Because if I give you a cookie cutter hedging rule book, it's going to get you in trouble because we all have different needs, risk tolerances, and what we really need to be paying attention to is how these hedges trade in real time and how that matches up with our needs. Okay, so I think it would be a good idea to wrap up this particular video on put debit spreads with these key takeaways. Put debit spreads must be designed around their intended role. Structures built for active management may differ from those intended to be held to expiration. And if you're going to manage these actively, you want to optimize for that T plus 0 behavior, not expiration payoffs. Spread width creates optionality and provides multiple paths for adjustment and monetization. And when you're choosing strike selection as well as expiration, you want to design for adjustment from the start. This video is for educational purposes only and does not constitute investment, financial, or trading advice. No recommendations to buy or sell securities are being made. All examples are hypothetical and for illustration only. All investments carry risk, including the possible loss of principal. Options trading involves significant risk and is not suitable for all investors. Past performance is not indicative of future results. Consult a qualified financial advisor before implementing any strategy and review your financial situation, risk tolerance, costs, fees, and tax implications. Options trading requires broker approval, and not all strategies are permitted in all account types. Returns shown are hypothetical and not guaranteed. Market conditions can change quickly, and results will vary based on market performance, timing, and execution. Read characteristics and risks of standardized options from your broker or at www.optionsclearing.com before trading options.